You know those videos online where someone pulls up to a drag strip in a beat-up, boring-looking station wagon, and the car in the next lane is like a flashy million-dollar hypercar?
Oh, right. The sleeper cars.
Exactly. The light turns green, and that boring station wagon just absolutely rockets down the track. I mean, it leaves the hypercar completely in the dust because all the money, all the wild engineering is hidden entirely under the hood.
Yeah, you look at the exterior and expect absolutely nothing. You just assume it's another commuter vehicle. But the underlying mechanics are, operating on a completely different plane of existence.
That is the perfect image for the mission of today's deep dive. We're unpacking a fascinating presentation about a company that is the ultimate financial sleeper car. Okay, let's unpack this.
Let's do it.
The slide header here literally calls it TransDigm Group, the most lethal, boring stock in your portfolio. And if you just glance at their operations, they look like a run-of-the-mill, incredibly dull industrial manufacturer making metal widgets for airplanes.
Right. Very dull. But the sources we're analyzing today argue that under the hood, TransDigm is effectively a massive private equity firm wearing the trench coat of a boring industrial supplier.
Private equity firm in a trench coat. I love that.
It's so accurate, though. TransDigm ignores all the traditional rules of engineering or, manufacturing scale. Instead, they run a highly curated, ruthless value creation playbook.
Right.
They hunt down a highly critical aerospace part that absolutely no one else makes. They acquire the company that produces it, and then they recalibrate the price to reflect its actual value to a $100 million commercial jet.
Which is a lot more than the cost of the metal.
Exactly. And this specific high-leverage machine has delivered 20% plus annual returns for decades. That historical compounding is the foundation for the very strong buy recommendation our sources are issuing for the stock today.
So to understand how they actually pull those massive returns out of the aviation ecosystem, you really have to look at their structural positioning. The research had a great visual for this, calling TransDigm the toll booth of the global aerospace industry.
The toll booth analogy is perfect.
It really is. Because, you see Boeing and Airbus constantly dominating the news cycle, right? Getting all the flashy headlines for building massive airframes.
Yeah, the big shiny objects.
Meanwhile, TransDigm is quietly sitting on the tarmac, capturing the economic rent of the entire industry. They do it by owning the critical, non-discretionary intellectual property that keeps those specific planes in the sky.
And owning that toll booth makes TDG an incredibly robust inflation hedge, which, is vital in the current macroeconomic environment.
Oh, for sure.
The analysis gives TransDigm a buy score of 84 out of 100, targeting a price of $1,650 over a 1 to 3 year horizon. They do factor in a medium-high risk level, mainly due to the sheer scale of their financial leverage.
Right, the debt, which we'll get into later.
We definitely will. But the core argument is that current market volatility is essentially a valuation gift for you, the listener, provided you understand their structural advantage.
Right, and understanding that advantage leads us right into the understanding TransDigm's business model section of the presentation. Because if you're a standard commodity manufacturer stamping out interchangeable aluminum parts, you can't just demand people pay whatever you ask.
No, the customer will just go to the factory down the street.
Exactly. But TransDigm bypasses that problem entirely because they are a monopoly portfolio company.
Yeah, they rely on a self-reinforcing three-step flywheel that has compounded for over 2 decades. Step 1 is to acquire sole source, FAA-certified aerospace makers.
Sole source meaning they're the only ones making it.
Precisely. Then, step 2, apply value-based pricing to extract maximum economic rent from those captive parts. And step 3, generate high-margin aftermarket cash flows and immediately redeploy that capital to buy the next monopoly.
Okay, I have to push back a little here on behalf of anyone listening who tracks modern manufacturing. We live in an era of rapid prototyping and advanced materials.
Sure, 3D printing and all that.
Yeah, like if this specific flywheel is so lucrative, why couldn't a nimble tech startup just come along, 3D print these exact same aerospace parts for a fraction of the cost and steal TransDigm's entire market share overnight? The presentation addresses this in the core moat, Intellectual Property Monopolies section.
And what's fascinating here is that the physical manufacturing of the part isn't the actual product. TransDigm owns the legal right to be the only provider.
Wait, really? It's just about the legal right.
Essentially, yes, the moat defending this entire business has nothing to do with having the biggest factories or the cheapest supply chain. It's built entirely on regulatory certification barriers. They own the monopoly on the paperwork.
Oh, wow. The source material has a stark example to make this certification wall visceral. Imagine a simple aircraft valve. The raw materials and labor to make it might cost, say, $500. But that valve is sitting inside a commercial jet valued at $100 million.
And aerospace components operate under notoriously strict FAA or EASA certifications. If an airline wants to replace that $500 TransDigm valve with a cheaper generic equivalent, the new valve requires years of safety testing, stress validation, and millions of dollars in research and development just to clear the regulatory hurdles.
Just for a valve.
Just for a valve. No airline chief mechanic will ever risk installing an uncertified substitute on a $100 million asset to save a few $100. The risk-to-reward ratio for displacing a TransDigm part is completely broken.
That makes total sense. And under the section value-based pricing, the research explains that because the airlines are trapped behind that certification wall, TransDigm has total freedom to dictate the price of that little valve.
Oh, absolutely.
Think about an AOG event aircraft on ground. If a commercial wide-body is stuck on the tarmac because a proprietary latch is broken, that airline is bleeding anywhere from $50,000 to $150,000 per hour.
Per hour. That's in lost revenue, rebooking fees, idle crew costs.
Yeah, so suddenly the sticker price on a replacement latch becomes highly relative.
Exactly. TransDigm prices their parts based on the cost of the disaster they are preventing, not the cost of the raw aluminum. When an airline operator is staring down a $150,000 hourly loss because a plane is grounded, spending $5,000 on an overnighted replacement valve is an absolute bargain.
I mean, they'll pay whatever it takes.
They are paying for the immediate restoration of their revenue-generating asset, and TransDigm knows precisely how to price up to that pain point.
But for value-based pricing to hold up, the airline must have literally nowhere else to turn. If there were a second certified supplier for that specific valve, the airline would just call them and trigger a price war.
Which is why the sole source dominance aspect is so crucial.
Right. Our sources highlight a staggering metric here. Approximately 90% of TransDigm's revenue comes from proprietary sole source products.
90%.
90%.
And that 90% figure is a strict, non-negotiable acquisition criterion. When TransDigm evaluates a target business, if they find that the target's products face any meaningful competition from other certified suppliers, they just walk away.
They don't even try to compete.
Not at all. They are not interested in fighting for market share. They only buy isolated monopolies.
So if a well-funded competitor looked at those margins and decided to aggressively challenge a sole source part, they'd have to run a massive gauntlet. The presentation asks, the certification mode, how deep is the trench?
It's very deep.
Our sources outline this pyramid of barriers. First, you face 2 to 5 years just to get FAA-type certification. Then you need another 1 to 2 years for airline qualification testing and 1 to 3 years for the OEM to approve the integration.
Plus, you take on the catastrophic liability risk if your new part fails mid-flight.
Yeah, that liability is huge.
Synthesizing the math on that pyramid reveals exactly why the moat is impenetrable. A competitor is looking at 8 to 10 years of grueling regulatory red tape alongside development costs ranging from $5 million to over $50 million.
Wow, a decade of work.
And the prize at the end of that decade of capital burn is displacing a single component that might only yield a few $1,000,000 in annual revenue. It is an insurmountable barrier. Challenging TransDigm on an individual part basis is economically irrational.
Okay, here's where it gets really interesting. This total lack of competition creates a financial profile that looks like it belongs to a completely different sector. There's a slide called Financial Benchmarking, Industrial Software Margins.
Yes, that slide is eye-opening.
You look at their metrics, and TransDigm boasts gross margins of around 59%. The industrial average for manufacturing sits at roughly 25%.
And their EBITDA margins are hovering near 52% compared to an industry average of just 18%.
It's wild. By focusing relentlessly on small, light, mission-critical components, they basically defy the laws of industrial physics.
Right, because a 52% EBITDA margin is not a cyclical, capital-intensive metal-bending metric. Those are durable structural margins that rival big tech software companies. They're running a software-as-a-service margin profile in the physical world.
Stack TransDigm up against the heavyweights of their own aerospace sector to really see that 34-point gap in gross margins. Under the margin profile versus peers, visual comparison, the research plots them directly against peers like Howmet, Spirit Aerosystems, Raytheon, and HEICO.
And TransDigm exists in an entirely separate category on that chart.
Yeah, they do.
Take HEICO, for example, widely considered their closest equivalent in the aerospace aftermarket. HEICO trails TransDigm by over 20 margin points on EBITDA.
Wow. Even their closest peer.
Exactly. This empirical fingerprint proves TransDigm's outperformance isn't rooted in operational excellence on the factory floor. It relies entirely on aggressive structural pricing power.
But you don't hit software-like margins across dozens of physical manufacturing companies by accident. It requires a really systematic approach. The presentation labels this the value creation playbook, a repeatable machine.
Yes, and TransDigm's management has applied this specific three-step playbook with machine-like consistency for over 30 years.
30 years of doing exactly the same thing.
Right. And this playbook is not a turnaround strategy for distressed assets. It is purely a value extraction and compounding system applied specifically to curated, irreplaceable businesses. The companies they buy are already manufacturing vital parts.
TransDigm simply steps in to optimize the financial reality of those parts.
Exactly.
So step one of this playbook kicks in the second an acquisition closes. The slide calls it price to value. They immediately adjust the prices of the newly acquired parts upward.
Because the previous owners usually price the part based on a cost-plus model, which leaves massive amounts of money on the table.
Right. They just price it based on what it costs to make.
Right. TransDigm realizes they are the sole source and recalibrates the price to reflect the true value to the aircraft operator. This single pricing action often drives 20 to 40% revenue uplifts within the first 12 months of closing a deal.
That's huge.
Yeah.
But they don't stop at the top line, right? They immediately gut the bottom line. Step two is cost rationalization. They aggressively eliminate overhead, wipe out redundant management layers, and slash any non-core research and development.
Yeah, they strip the newly acquired entity down to its bare cash-generating core. If a legacy project isn't going to directly support the sole source moat, it is terminated.
Gone.
Gone. This drastic reduction in operating expenses creates an immediate structural margin expansion that compounds the revenue boost from those initial price hikes.
Okay, so once they have this incredibly lean, highly profitable asset, they have to ensure it stays a monopoly. That's step three. Reinvest in sole source IP. They redeploy the newly freed up capital strictly into new product development.
And the discipline in their capital allocation is remarkable here. They only invest in proprietary R&D that directly widens the certification wall.
No vanity projects.
None.